Your financial life is greatly influenced by your credit scores. Your credit score is one of the main elements that creditors like banks and credit card companies use when deciding whether to approve your application or not. There are many myths surrounding credit scores, some of which might actually impair your score. A good credit score offers many benefits, while a bad score can do you a lot of harm. The importance of this number necessitates that everyone comprehends how credit scores process. What's up, guys? My name is Gilberto from Credit Guys. Like and subscribe for all things credit and finance related. Here are 9 of the most widespread myths about credit scores. Number 1, my credit score drops when you check it. The most prevalent myth is certainly this one. You can measure your progress when establishing credit by keeping an eye on your score, but it's crucial to check it correctly. An activity known as a soft pull, such as checking your credit score, has no impact on your credit score. A hard pull, such as when you apply for a credit card, momentarily lowers your credit score. Lenders may reduce your score by pulling your credit history. However, reviewing your personal credit report starts a soft inquiry that shouldn't have an impact on your credit score. Therefore, don't be reluctant to check your credit. In fact, check it frequently to assess where you stand, identify issues when they arise, and monitor your development over time. Myth number 2, your score depends on your income. Your income and salary are viewed as indicators of your ability to pay your expenses, not of your likelihood of being denied credit. One of the most prevalent myths that people hold to is this one. In reality, your credit score is not directly impacted by your salary. The number of credit products you have and how well you handle payments determines your credit score. Therefore, your credit score is unaffected by your salary. Payment history, credit utilization rate, indebtedness, length of credit history, frequency of new credit, and credit mix are some of the factors that affect a true credit score. Myth number 3, credit scores may benefit from debit cards. Nearly 50% of people believe that debit cards can improve credit ratings or credit histories. But in reality, debit cards have no bearing on your credit history and credit scores. Using a debit card is quite similar to using cash. Even if you choose credit at the transaction, this only affects the merchant's processing of the card and the expenses it incurs. Myth number 4, debt repayment removes any reference to it from your credit report. Your old accounts remain on your credit report for several years, whether they have been paid off or not. Bankruptcies and late payments may appear there for up to 10 years, respectively. Luckily, the lengthy memory of your credit report works in your favor as well. Your wise financial decisions are noted when you make on-time debt payments or reduce your balances. Your report will gradually reflect more of these sound credit practices while lessening the influence of older, damaging data. Myth number 5, poor credit ratings persist forever. According to what you may have heard, if you work towards it, a low credit score can increase in a few months. Payment default data may stay on your credit report for a number of years, but good credit habits like prompt payments, limited credit use, and a limited number of credit inquiries can all help you raise your credit score. Myth number 6, you will raise your credit score by removing inactive credit card accounts. The cards can let you build up a massive quantity of unused credit if you're really not using them. They are and therefore an asset to your credit score that you should protect. So keep the accounts open and store any unused cards in a secure location where they can't be stolen. Closing them will increase your credit utilization ratio, which will almost certainly have a negative effect on your credit score. Myth number 7, a high credit score indicates wealth. As was said already, your salary has nothing to do with your credit score. Your credit risk is only assessed using your credit score. Despite having a low salary, if you have a history of timely monthly bill payments and a decent mix of credit, you're viewed as a good credit risk. A larger credit limit isn't given just because you earn a higher salary, but if you update your income information with your card issuers to a higher figure, you might see an increase in your credit limit. This could help lower your credit utilization ratio. Your likelihood of defaulting on your debts is indicated by your credit score. Myth number 8, your credit score increases by disputing all inaccuracies on your credit report. Your credit report may contain a number of inaccuracies, including those involving your personal information, improper transactions, or wrong entries. The agency will ask the lender to validate these inconsistencies if you file a complaint. If the disputed item is included in the Bureau's scoring methodology and the creditor agrees to the adjustment, the credit score may alter. Your credit score may not be impacted or improved by disputing all inaccuracies on your credit report, though. Myth number 9, student loan debt has no impact on credit score. Your credit score is impacted by all forms of loans, including those for a car, a house, a personal loan, a student loan, a mortgage, and medical expenses. Therefore, to keep a high credit score, pay all of your debts on time, whether they are credit card bills or student loans, personal loans, credit cards, etc. So, These were the top myths that most people believe will affect their credit score. We hope that this helps you understand how the card scoring system actually works. Be sure to like and subscribe for more content. Thank you guys.